What's going on with the banks? During this crisis, this is the number one question that we are getting from buyers, sellers, and all agents. Hey everybody, Matthew Bizzarro here, broker owner of the Bizzarro Agency. And I just wanted to pull over quickly in this beautiful park on this beautiful day to touch base a little bit about what is going on with the banks, because this is a question we're seeing daily, if not hourly right now in our industry. And I want to just give you a little insight so you can be informed, especially if you're a real estate agent who is looking to have to answer this question, most likely on a daily basis, to all of your clients. So what is going on with the banks? Right now, the banks are moving into what is called recession mode. A lot of them have just filed their quarterly report and their earnings, and they are showing that they are moving millions of dollars into forbearance accounts, into the accounts where they are anticipating people to not be able to pay their mortgage. And some of them are even saying, yes, that's starting now, because a lot of the people that are taking the forbearance due to COVID for the next 3 months, that's technically considered actually a non-payment. Now, obviously it's okay now, but you can see the bank's thinking. It's important to understand what the bank is thinking so you can then understand where they're going with lending. So they're already preparing for millions of dollars of defaults to come. So in order for them to issue a loan now, they're going to be very sure that the person they can loan to is able to get a loan. So what's happening when they start recession mode? That means the qualifications of the buyers need to be better. Anyone that's just skirting through with barely enough income, a questionable job, and a credit score of 650, 660 is probably not going to be able to get a loan now. The banks are looking at, if they're going to lend, they want to make sure that the person they're lending to is more qualified. So what are we seeing across the board? We're seeing an increase in credit score. A high 600 credit score used to be able to get you a loan with some banks. Now the majority of banks are looking for you to be over 700, if not in the mid 700s right now. They're looking for more assets. They're also looking for jobs and employment. We've been told by several big banks that they're now verifying the employment process 2 to 3 times more during the loan process than they've ever done before, to make sure that you're continuing to have employment. Obviously, this is something you want to look at if you're bringing a client to purchase, because if they are getting a loan, they are certainly going to need to have employment in order to get a loan. So credit scores going up is the first thing we're seeing. What about down payments? As first-time home buyers, a lot of them come in with 10%. There's many big banks right now that is getting rid of 10% loans and saying we're only going to 20% loans. There's a few banks that are also saying instead of 20, we're only doing 25% loans to hedge our risk. A lot of the closing costs programs are staying intact, but what we're seeing is they're going to be not paying for PMI anymore, private mortgage insurance, what you put down to cover the difference of the 10% if you put down 10% as opposed to 20%. So only a few banks will be issuing 10% loans right now. And again, that could change, right? Some of the big commercial lenders, let's say, so the Citibank, Chase, Wells Fargo, Bank of America, the big banks, what they're telling us is they are desiring increased credit scores, but what they're also doing is they're selling the majority of their loans off more so to Fannie and Freddie. So these are government loans, correct? So in order to sell your loan to Fannie and Freddie, there's another whole checklist. There's another whole set of requirements that the applicant and the building, if it's a co-op or a condo, needs to meet. So when we see a lot of especially the lower end loans under $500,000, $600,000, $700,000, if they're being sold off, that means the bank has to be more restrictive, because they're not going to hold it. If they're going to sell it to the government, they need to make sure that they're making all these checklists. Now, part of that is credit score, employment income. But when you're talking co-ops and condos, they're also talking building requirements, higher owner occupancy, financials, and the whole picture of the building now matters more than ever. So something to think about. How do we pivot through this? Well, my professional suggestion is to get to know some portfolio lenders. So portfolio lenders, if you're not familiar with this term and you're in real estate, you need to get familiar with this term fast. Portfolio lenders are banks, generally smaller banks, that choose to hold on to the loan for their portfolio. They don't sell it to Fannie and Freddie. They don't sell it off to the government. So because they keep it for their portfolio to make money on the interest, they can have a little bit of looser lending requirements because they're holding it. They're not looking to sell it. They're not looking to need these checklists to make sure if they decide to sell it. They're planning on holding it the whole time. So where this can make a difference is, for example, building, right? Where an owner occupancy has to be this high to be able to have the loan sold. A portfolio lender is going to be able to take the risk and loan in buildings with a little bit less because they know they're going to hold on to it. All right. Now, what are we seeing with the portfolio lenders? Because they are smaller, many of them are doing one of two things. They're increasing down payment to hedge their risk. So they're going from 10 to 20, some from 20 to 25%. And some of the smaller portfolio banks, they're going on a case-by-case basis, saying, yeah, we're lending, but we're actually reviewing each loan as it comes in. We're not bulk lending. Yep, bring it in, we'll process it. So these are all very important things to know going into this climate, into this industry, so that when you start, you know, we have friends all across the country that are, some states are deemed, real estate is deemed essential, some is not, some it's only if it's urgent. So no matter where you are in that, eventually, if you're not having them now, eventually you're going to start to have conversations with your clients that are looking to buy, or your sellers who have asked you to find a buyer for their house. They need to also understand what's going on in the market in terms of mortgages, because unless you're able to extract a cash buyer, that buyer is going to need a mortgage. So they're going to need to be explained about the climate and the conditions, and that things are just generally taking a lot longer. Now, speaking of that real quick, in terms of it taking a lot longer, you also have to remember a couple weeks back when the interest rates really dropped and refis went through the roof. And because it's taking longer, you as the professional need to make sure that you're setting the correct expectations, not only for your clients, for your buyers, but also for your sellers. By no means should you set the expectation that loans are going to close quickly and that they're lending aggressively. By setting the correct expectations is going to help you manage your process and your transaction so that everybody gets along, so that everybody is happy. Should you have more questions about lending, about banks, send me a DM, shoot me a text. I'm happy to talk more about it. But it's an ever-changing situation as well. Every week, things are changing, so it's something we want to keep a pulse on. But make sure you are informed, make sure you know what's going on, and if you don't, make sure you have a good portfolio lender in your arsenal, on your team, that you can refer your clients to. All right, have a beautiful day. Talk soon.